All right, chapter 12 is our statement of cash flows. This is the fourth and final financial statement that we have in 241 and 242. We've done the income statement, statement of retained earnings, and the balance sheet. And this one is the last one. The information that we use for the statement of cash flows is the same information. We're just going to analyze the income statement and our statement of retained earnings and our balance sheet to find this data. So it's already available to us, but we're basically going to look at how can I find my. It's a big proof, is what it is. It's a big, long, in financial statement form of proof to analyze the change in cash from one year to the next. I could go to my bank statement and just see what went in and what went out, but we actually want to see what affected my cash balance and what my accounts did through my current assets, current liabilities, long term assets, long term liabilities, and we're going to prove how we got at non cash based income, and we're going to reconcile that to how my cash went up and down. So we're almost converting our GAAP based net income. We're going to convert that to a cash based net income. That way we can see how our cash went from, say, $1,000 at the beginning of the year to $2,000 at the end of the year. Okay. All right. So, again, cash is important. It's, no matter how we look at this, we can look at our GAAP based financial statements and look at what our true GAAP based income is. But if we're not having any cash come in our company, then we have a significant problem. Okay. Um, so we're going to have to make sure that we have this going the right way. All right. All right. So, how do we get our cash? What changes the account balances? Um, where do we spend our cash, and what other inflows and outflows of cash do we have? Okay. We're going to divide this into three sections. All right. Um, it helps us to know if we're going to how we're going to pay our debts, evaluates our any kind of new business opportunities we may have, plan our day to day operations. This is all stuff that we've looked at before. Some of these ratios we've had, some I just talked about in 241 about our current ratio. I mean, I can look at that without the ratio to know that if I have, you know, less cash than I have accounts payable, then I have a problem paying my bills in the next 30 days. All right. I think we all understand that already. So, okay. Um, all right. So, measure of cash flows, cash equivalents, easily convertible to cash or close to maturity. So it's not going to be affected by any kind of interest rate changes. These are just kind of things we're going to look at. Here's our three main types. Now we're getting to the actual main crux of what our statement of cash flows looks like. When we divide this financial statement up, we're looking at three different sections, three different types of financing and cash flow activities. Your operating activities, that's normal things that happen in our operations. Okay, that's stuff that happens from our day to day operations. Stuff that we're going to be cash payments for coming in from our customers, cash payments going out to our vendors, and we're going to analyze where our cash has come in from, where our cash has gone out from our normal operating activities. All right. Investing is investing in our business. Do we buy anything big? And financing is essentially retained earnings. It's our equity section of our balance sheet. Do we have any new stock purchases? Do we have any new stock issuances? So that's where our three statements, our three sections of the statement are going to come from. All right. Operating activity, you've got regular cash sales to customers. Um, we have collection of credit sales. So you have to think about it. We're going to analyze our accounts receivable. So, in our normal setup, we have receivables and we have sales. Well, it's very possible that's already included in net income for last year, right? But we may not collect it until next year. So if we have a change in our accounts receivable, we're going to have to analyze that change to say that, we've already included it in net income in a prior year, but we didn't get the cash until this year. So that's why my cash balance went up. I actually received last year's cash. All right, so that's the proof that I'm looking at. When I say proof, I'm talking about like a mathematical proof like we do in calculus. I'm saying that I'm looking at a way of proving and doing this proof of saying that I want to go through and say, where did my money come from? So it's very possible that I'm collecting last year's net income. I'm collecting the cash for that this year. So we just have to do an analysis of each one of these accounts. All right. Investing, selling assets, selling investments, collecting principals on notes. These are things that's not our core businesses. It's not the stuff that we're actually in business for that sometimes we do in our business, but it's not what we're really trying to do. We're buying assets. All right. So that's something that we have to do that's kind of part of our business, things that we need to make money, but we're not, necessarily just in business to buy assets because we have to use those to generate income as well. And then financing is contribution from owners. It's not income. So it's not going to be on net income. Issuing any kind of debt to bring in cash. So we can issue bonds, anything like that at all. We have new stock, right? And then of course dividends is going to reduce that. It's going to be cash in a cash outflow that goes out. All right. So you can see here, most of the time, current assets and current liabilities are in operating our cash flows. It's operating cash flows. Long-term assets is investing, and long-term liabilities and equity is going to be financing. Um, so here's there's a couple of things we have to look at on our books. We did this in chapter 3. I just covered this in our 241 class. So put on your, last semester hat and look at this stuff. There's going to be a couple of entries we make and a couple of adjustments we make in our statement of cash flows almost every time, right off the bat. Um, it's kind of some of those things that we do that are almost automatic. So think back to your adjusting entries that we make. And of course, we did a whole other chapter on it toward the end of 241 on depreciation. And I regret that I can't have y'all answer this question to me right, face to face, but there's no cash in that entry. Okay, there's no cash in that entry. So to arrive at net income, you have taken an expense of depreciation. We've debited depreciation and credited accumulated. But in that entry, there is no cash involved. That's a non-cash expense. So when we start, that's going to be one of the first things we adjust. We add that back to net income because that's a non-cash entry. All right. So when we have some of these non-cash activities, we can go back and just add those things in almost automatically. We'll talk about gain or loss when we do that as well. All right. So here's what your statement of cash flows is going to look like. All right. Um, we have this kind of middle section here. You have cash flows from operating activities, and you have cash from investing, cash from financing. It's going to give us our net increase or decrease in cash. So it's like any other calculation we've done, whether it's retained earnings, inventory. You have your beginning, increases, decreases, ending balance. That's what we're trying to do here. The difference is we start with net income. Okay, we are trying to reconcile how we arrived at net income, any changes through this method here, and how it affected our beginning balance of cash and our ending balance. By starting with my net income, I should get a net change in cash that should prove my beginning balance to my ending balance. But we're always going to start with net income. We're not going to start with our beginning cash balance. We're going to start with net income, and we're going to adjust it up and down based on how these accounts are affected. Okay? All right. All right. All right. So you've got two methods, and that's what this slide is saying. We have two ways of doing this. The natural way to look for information is to just go to your cash account. All right. That's a direct method. That's what that would be called. It's called the direct method, is to just pull up your check register and look for deposits and checks and see how did I get from point A to point B in my checking account. And you could get there because that's what your account started with. It started with $500 in the beginning of the year, and you ended up with $700 at the end. You have all these transactions in the middle that were pluses and minuses that got you to $700 at the end. All right. However, that's not a gap-based financial statement. We have created another gap-based financial statement that analyzes changes in accounts because that's relevant information to me as to, well, how did I really get there? Where did the money really come from? Where did I really spend the money in arriving at the change in cash? Okay. So here's the second approach. All right. This is the actual gap-based approach. Is preparing the statement of cash flows and is analyzing non-cash accounts and draws on the double entry accounting that we've already been doing. All right. It affects every account, even when you go in. So when I write a check, all right, it affects both sides. I'm going to have cash I could have an expense in cash. I could have, debit, and I could have for cash, and I could have a credit for revenue. Or, as I mentioned before, what I could have is I could have a deposit for cash, and I could have credit at accounts receivable. Okay, so in that case, I don't have anything that's affected my income statement. I have something that was already on my books, and it was accounted for maybe in a prior period, maybe in a prior year. It was revenue. It was revenue in a prior period. In the converse, I could have accounts payable that's my debit, and I could have cash that's my credit. So I could be paying off a vendor for a bill that I showed as an expense in a prior year as well. So we're going to analyze those current asset, current liability accounts to see, did they really go up? Okay. So as I start on the next couple of slides here, this is going to be several videos long because this is a really important um, part of the course, and I want to make sure I cover all this slowly. But this is going to be several slides here, several videos. So I'm going to stop here before I go to the next slide, and we'll pick up in just a second.